Hello! It seems you've stumbled into my study quarters. I make these videos for myself, but feel free to watch it if you want. Let's learn the golden rules of accounting. The most common way of recording business transactions is the double entry system. It operates on the belief that in every transaction there are two equal effects, a debit effect and a credit effect. And that for every debit there is a corresponding credit, which means debit is always equal to credit and vice versa. Now, the accounting process as a whole has certain rules we must abide by when we record business transactions. So let's look at the golden rules of accounting. Please note that business transactions are always recorded from the firm's point of view. Now, there are three main accounts, a real account, a nominal account, and a personal account. Let's take a look. In real accounts, we record all transactions relating to assets of the business. These assets can be tangible or intangible. Tangible assets are basically those which you can touch and feel, like land, buildings, machinery, etc. Intangible assets are those which you cannot physically see nor touch, like goodwill, patents, copyrights, trademarks, etc. Real accounts are long-term assets. Some examples are cash account, furniture account, machinery account, stock account, vehicles account, etc. Nominal account. All accounts which record transactions relating to the incomes and gains of a firm and the expenses and losses of a firm. Income and gains can be sales, rent, commissions, etc. Expenses and losses can be salaries, rent paid, stationery, etc. Personal accounts. These accounts relate to entities or individuals. They are as follows. Natural persons like you and me come under personal accounts. Examples for humans are, Ram, Mohan and Aisha account. Artificial or legal persons. These are business entities having a separate legal status, such as banks and NGOs, etc. Representative accounts are accounts which indirectly represent a person or a group of people. For example, prepaid expenses, accrued income, etc. Since we now know what these accounts represent, let's take a further look. As mentioned before, every transaction has a dual credit and debit aspect. Each account, real, personal or nominal, has its own way of recording debit and credit too. In real accounts, we debit what comes in and we credit what goes out. Let's take an example for real account. Let's say you want to buy some furniture. Furniture is an asset. What can we say then? Furniture comes in and cash goes out. We debit what comes in and credit what goes out. So we debit the furniture account and credit the cash or bank account. Let's look at nominal accounts. Here we debit all expenses and losses and we credit all income and sales. Now, we already know that nominal accounts record all transactions relating to income, gains, and expenses and losses. So let's take an example. Let us say you need to pay one of your employees his salary. That is an expense for you, right? So, in nominal accounts, we debit expenses, but cash is an asset. So what do? Well, we borrowed the principle from real accounts. Accounting is kind of like mixing and matching. Applying this, we have a nominal account and a real account. So we debit our expenses, which are the salaries, and we credit what goes out, which is cash. Let's take a look at personal accounts. Here, we debit the receiver and credit the giver. Let's take an example, shall we? Let's say that Miss Sita commenced a business with 1 lakh rupees. We already know that cash is a real account, and in this case, the giver is Miss Sita. So we debit the cash and we credit the giver, who is Miss Sita. There you go. So let's take a look at a few more examples. Transaction. Started a business with a capital of 1,000. Does not matter which currency it is. We know the accounts here are a bank account and a capital account. And the type of account is that both of these are personal accounts. A bank and capital are both personal accounts. Here we debit the receiver and credit the giver. In this case, the receiver is the bank and the giver is the capital account. Transaction 2. Wages and salaries paid. We know that the accounts involved are a wages/salary account and a bank account, because that's how you pay. The type of account is that wages are, a normal account and a bank account is a personal account. So what do we do here? We debit the expenses and credit the giver. So we debit the wages and salaries and credit the bank. Transaction 3. Rent received. Okay. Well, we know that the accounts involved are a bank account and a rent account, right? And the type of account is a personal account and a nominal account, because a rent is an income and a bank, it's a personal account. Here, we debit the receiver and we credit what comes in. Hence, we debit the bank and credit the rent. Third transaction, I think. Purchases made on credit. Well, the accounts involved over here are a purchases account and a creditor account. The types of accounts are a nominal account and a personal account. Now, let's see. We debit the expenses and we credit the giver. So we debit the purchases account and we credit the creditors. That's about it when it comes to the golden rules of accounting. We will learn journal entries soon. Bye!